Hello, everyone, and welcome to the Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head the G10FX strategy team here at NatWest. And this week especially, we saw maybe not a return, but a reassertion of geopolitical risks in foreign exchange markets, really coming from emerging markets. We saw the results of elections in several major emerging market economies. Each of the election results we saw this week probably deserves a podcast of its own, but given they all came in such close proximity to each other, we're going to talk about them each in turn in this sort of EM election special. So I'm very glad to be joined by our EM strategist to talk through these elections. Aditya Sharma from our India team to discuss the India election, Eimear Daly out of London to discuss the South Africa election and implications for the Tsar, and then Alvaro Vivanco, who heads our EM strategy team, to discuss Mexico and implications for broader EM. So I want to thank you all for joining. And Aditya, I'm going to start with you. India's election, India is certainly the largest of these economies and perhaps the most globally impactful. What were the results of the elections and how is the market interpreting this so far?
Thanks, Brian. The results that we have got this week from India have clearly defied market expectations. The BJP has got around 240 seats in the parliament. They need around 272 to get a parliament majority and to be able to form a government. We still think they'll be able to form a government with its alliance partners, but I think that's not something the markets had anticipated before the elections. Even before the election had started, the opinion polls were predicting BJP to probably increase its previous tally, which was around 303 seats before, and exit polls had also predicted a huge increase in BJP tally from before. But that's not happened, and that brings me to the most important implication from this election and the most important takeaway from this election, which is the coalition politics is back in India. And the way I see this, it's going to be, investors are going to attach a political risk premium on Indian assets going forward, something that they didn't have to worry about in the last decade or so because the Modi government had really a strong majority in the parliament. Now, with this alliance coalition government, I think they're going to attach a political risk premium. Plus, you're going to see a weaker government in the parliament in terms of decision making. And the reason I say so is that the appetite of this government, the new government that would be formed, would probably be very low to take bold decisions. Something that economists have repeatedly pointed out that India has to implement factor reforms related to farm, agricultural, and related to land, agriculture, and labor. But I don't see that the new government would be touching upon any of these reforms. And the reason for that is probably the BJP government tried to implement farm laws in the previous term. They faced a huge backlash. They had to roll back. And with this new coalition government, probably they're not even going to be touching any of these reforms. Infrastructure and manufacturing would still be important under this new government. And the reason is these sectors have the key to probably generate a lot of employment. But the other important fact is that fiscal consolidation could be slower under this new government. And the reason I'm saying this is populist promises have really polled positively in this election. And I think the BJP would take cues from the opposition and would like to bring some of these populist promises and policies into in this new government. And that would mean that fiscal consolidation would be slower than what we had expected before. Bond markets are clearly reflecting that. And that's the reason we saw the bond market reaction on the day of the results. 10-year yields had spiked 10 basis points on the day of the results. In terms of the implication for assets, I just feel that equity valuations were very rich even heading into the elections. And with the new reality where the BJP government is not able to form a strong majority by itself, I think equity outflows could continue in the near term. Growth could probably be revised lower because with the coalition government, policy implementation might be slower. There could be there could also be times when the stability of the new government would be under the question. So these factors could impact growth, and I think growth has the potential to be revised lower. The other point with respect to bond markets is that if fiscal consolidation is lower, then I think bond flows could also be muted. Although we have bond index inclusion this month, we would see probably passive flows coming into India for the next few months, but I think that's going to be lower than what we had anticipated before a strong portfolio inflows after the elections. I also feel that long-term investments into India, in terms of FDI flows, would take some time to start coming back into India, and the reason for that is investors would look for the stability, would look for policy directionality before committing investments into India. Overall, from the perspective of currency, I just feel that with lower portfolio inflows, with growth getting revised lower, FDI inflows staying muted, I just feel that the currency, the upper bound for USD INR could probably shift slightly higher, maybe around 84. And I don't see a lot of catalyst for the currency to appreciate from here. The RBI would be probably active in the markets, curbing volatility, but I see some more downside for the currency from here. That's assuming the base case that the BJP government is able to form a government at the center with its alliance partners. If they are not able to form a government, or if, in case any of these alliance partners decide to switch sides, which they have done in the past, two of its key alliance partners, which have around 30 seats in the parliament, which is very important for the BJP to be able to form a government at the center, they have the history of switching sides. And if they do so opportunistically in the next 5-year term, I think the downside for rupee could be even more from here.
Thanks, Aditya. A really good summary. I mean, I think you sort of hit the nail on the head in terms of having to price sort of fiscal and coalition risk into Indian assets for the first time in a long time. And I think, for the currency, it's been in a pretty stable range, for quite a while, and seeing potentially some upside risks to that range for dollar INR feels appropriate here. Is talking about an existing government losing their majority and having to deal with coalition government for the first time in a long time. I think this is a great opportunity to transition to South Africa's election as well, because a very similar dynamic has happened in South Africa, where the ruling party is now no longer ruling with the majority. Is that right, Eimear? Can you talk about some of the results and how the markets have interpreted this?
Yeah, you're absolutely right. So the ruling ANC has basically led South Africa with a parliamentary majority since the end of apartheid. So it's had 30 years of kind of dominance of one-party rule in South Africa. Going into this election, everyone had expected to lose its parliamentary majority and to have to form a coalition government. However, I don't think anyone expected this degree of electoral losses. I think what was really interesting is that it came at the hands of primarily one party, which was the party run by former President Jacob Zuma's MK party. Jacob Zuma is, kind of accused of presiding over 9 years in power of South Africa. We had widespread corruption and the hollowing out of state-owned enterprises, but yet his party kind of emerged as, the third largest political party in South Africa. In terms of the electoral implications, it really means that now the ANC will have to form a coalition government with some of its biggest, political rivals, some of those really big political parties, as opposed to kind of the expectation going in that they could form or cobble together a parliamentary majority with some of the smaller parties really maintaining policy continuity.
So when it comes to coalition building, I think there are clear differences in potential policy implications for which party ends up being the ANC's coalition partner. Can you talk through some of the nuances there, and what are your expectations? What's on the line for fiscal policy and for the currency in one coalition result versus the other?
Yeah, well, the ANC really faces stark choices. So effectively, they could partner with the EFF and MK, which are very, extremist, far left political parties. They want to nationalize the mining sector, the banking sector. In the case of MK, they want to scrap the constitution, but it already also has kind of geopolitical considerations. So both of them are kind of more pro-China, pro-Russia. They want to pivot away from the Western sphere of influence, where the opposite is a coalition or some kind of agreement with the Democratic Alliance and potentially the IFP. And that would really shift South Africa back to centrist. These are parties which, campaign on reform momentum, or bringing in private sector capital into the electricity and mining sector, and also kind of reestablishing and strengthening those ties with the West. to kind of gain back those kind of more traditional alliances. So I think in terms of the currency, you face really big two-way risk. On one side, if you get, a tie-up with the far left, you're going to see considerable ZAR weakness, and we could see it trading to an all-time record low. We see significant outflow out of, equity and bond markets, and you could really see, bond yields spike higher. If you've got, a tie-up on the other hand with a more centrist Democratic Alliance and the IFP, it's a reform scenario. You will see a relief rally in the South African rands. You'll see investors going back in, really kind of optimism coming back into play in South African assets. So it really is kind of two big tail risks.
Thanks, Eimear. Can I ask you, is there a timeline when investors can expect a little bit more clarity on how this is going? Or is it more we just have to wait and just watch the negotiations on a minute by minute perspective? Because, it certainly feels like with this two-way risk very front of mind, just curious, is this something that could be resolved very quickly, or is it something we should be expecting to maybe be in negotiations for a long time?
Yeah, absolutely. There is a deadline. So June 16th, essentially, as soon as those official election results were announced last Sunday, the clock started ticking. They have 2 weeks to actually try to form a government and elect a president in Parliament. However, we are expected today, which is Thursday, to get an announcement from Ramaphosa in terms of which option the ANC prefers, so what type of government they will choose. I have to say, it's not entirely in their court. They are now going into, this whole sphere of kind of coalition governments, and will also be decided between what is feasible. I think the political landscape in South Africa is so drastically different that there are parties that just will not enter any kind of governing arrangement with, parties from the other kind of political side. So we'll get that announcement today. We should really watch out for actually how, other political parties respond.
Thanks, Eimear. I mean, it's in some ways it feels like the real results of the election are still pending as we record on Thursday, as we await the potential shape of the new South African government. So I want to pivot across the Atlantic to Mexico, where we had a result. In the first two elections we talked about, we had results where the ruling party won, but with less support than expected, and that had clear implications for markets. But in Mexico, Alvaro, it was the exact opposite, where the ruling party won in a much more dominant fashion, although the market still, that was unexpected. Can you talk through the results of the Mexico election and how the markets took it?
Yeah, absolutely. Thank you, Brian. Before I jump into the implications for market, maybe just highlight the point that for the first time, Mexico will have a woman president, which is very historic and very exciting, and something that we should all celebrate. That was almost a given that the two leading candidates happen to be a woman, but definitely a historic point for Mexico. In terms of markets and implications, I think Mexico is different in two ways. One that you mentioned is that actually the incumbent did much better than expected, right? So the presidential candidate that basically is the continuity of the current president got almost 60% of the votes, which is just remarkable, right? Given the polarization that we have globally and just how unpopular, for various reasons, incumbents have been across both developed and emerging markets. So the fact that there is just such a strong backing of a government that has had mixed results, definitely in terms of growth over the past 5 years, but there's enough popular support for the president herself to have a very, very strong mandate. And then the surprising factor, and something that really the markets had not been focusing on, I think in contrast to India and South Africa, which we have been talking about kind of the repercussions of elections, the market was kind of not focusing on this one in Mexico. And I think the most important surprise is that Morena, the ruling party at this point, will have a 2/3 majority, which allows it to implement constitutional reforms in the House. We don't know the exact results of the composition of parties in the Senate, but it feels like if not a full 2/3 majority, Morena will be just a few senators short of achieving that majority. And that matters because even though obviously this is continuity from this government, there are a few reforms more on the institutional side than necessarily related to macroeconomics, but there are a few reforms that have been blocked by Congress, right, by this relatively weak but still vibrant opposition that are going to be weakened over the next few years. And that's why we had such a strong reaction of the peso. I think that the context in which and the levels of the peso in particular at which these results happen are important. I mean, the Mexican peso has been a very, very popular trade. Everybody had been long essentially because of the carry and chasing this very high carry to volatility because Banxico, the central bank, has been so hawkish. So it came at a time where this was a very complacent consensus trade. We had been in the opposite side of that, not because we expected any type of surprise from the election, but simply because we thought that high carry was a little bit tired as a trade, and that's why we saw this significant reaction of the Mexican peso. I think of the three countries, in a way, is the easier one to analyze, right? Because there are some concerns on the fiscal, the same as the case of India, that the fiscal deficit in Mexico this year will be very, very high, one of the highest of the last several years. There will have to be consolidation. There's questions about the support of the government to the state-owned oil company. But in general, right, even the Minister of Finance will stay in his post, not only through the transition, but medium to long term. So we know the kind of macro policies that are likely to be, continue to be implemented under the new president. So in a way, I think it was mostly a positioning adjustment. It was more about levels for the peso, and we saw this jump from below 18 to below 17 to 18.2 at some point. Now it's stabilizing a little bit. So, I think it's more about just finding the right levels, finding some of this position to clear. There are some positive in Mexico, which definitely remain the case. If anything, probably the central bank will be a little bit more hawkish given this reality. So it backs that up. So it's more, I think, a tactical trade, just waiting for the right level to get back.
Yeah, I think you previewed my next question pretty well, Alvaro, which is just about broader implications for emerging markets and really also for G10 currencies, because this is probably the largest reaction you could have expected in yen and Swiss coming from really the Mexico election result, because those are the currencies which have the lowest carry in the G10. And I think what we saw across the board was carry trades under pressure, and as a result, funding currencies seeing relative gains, whether it be certainly the super low yielders in the G10 space. But what are some of the implications across broader emerging markets? I think you referenced one, which is sort of a lesser focus on carry and maybe more consideration for things like valuations and levels and sort of other macro drivers. Can you talk through some of the broader implications for emerging markets FX that you sort of take away from the results of these elections and how markets have interpreted them?
Yeah, I think that's a very good question, right? And I think that you could think of this as three different stories that happen to be at the same time, and they brought some surprises to the market. But I think the broader point, and I think something that has maybe not over the very long term, but at least for the next few months, change in EM, is that all of a sudden we're starting to see volatility, right? And in this case, it's political volatility, coalition uncertainty in the cases of India and South Africa, policy uncertainty in the case of Mexico. But we needed something to shake these markets, right? These markets are very complacent, low volatility, chasing carry for the sake of chasing carry, right? Without much regard for fundamentals and valuations. And I do feel that these elections have shifted that. This is something that we have been arguing, without a particular trigger for it over the last couple of months. And suddenly it feels like, we're going back, or at least, all the clients or the client questions that we're getting tend to be more specific, right? It used to be all the clients going to you, Brian, about the dollar and the Fed. And now, we're more in the weeds about, valuations and flows and, what's happening to commodities. So I think that that's a very healthy development for emerging markets. I also think that, the other thing that has not happened is all these geopolitical risks that we're going through being manifested in markets, right? Whether it's in emerging markets or equities or anything like that. And I feel like now, those risks also are starting to be a little bit more recognized in the markets. I think that, for instance, for the case of Mexico, and obviously this applies to other countries as well, the implications from the U.S. election in terms of the relationship. We are seeing some headlines even within the Biden administration regarding immigration with Mexico. Those are all things that we are very aware because, we had the past history of the previous elections, making a huge impact on things like the Mexican peso. I think it's been surprising how complacent the market has been about all of that. But I think, as we move into obviously a lot of other elections in developed markets, we're likely to see some of these surprises, which is, will give opportunities on both directions, obviously. But I think it has been a good eye-opening for a lot of people.
I think that's a really good point to focus in on market volatility because of its links, of course, to carry positions and the carry trade. The broader global macro environment has been one I think that's been generally conducive to falling volatility, whether it be because markets are expecting interest rates to continue to come down, inflation has moved lower, and growth in most economies has surprised generally to the top side relative to expectations at the beginning of the year. So it seems like the market's sort of pricing towards lower rates, lower inflation, soft landing style. And that all feels like it was generally pushing in a lower volatility direction. But like you said, Alvaro, maybe it doesn't take much to create especially localized volatility coming from geopolitical risk. And it's very hard not to think about the last week and not look ahead to the US election where consensus is particularly low in terms of who will win. But you just wonder, is the market going to become a little bit more concerned, a little bit more active, like you said, for global moves in foreign exchange markets? So with that, thank you guys very much for joining. I think it was a great conversation touching on a lot of different topics. And thank you to our listeners for listening to today's episode. If you enjoyed the podcast, please consider liking it and also subscribing to our channel so you get our latest episodes the moment they're released. Thank you very much.